To my YouTube channel, Finance for All. This is Soham Mandal, and the reason behind making this video is whenever I feel that there are many things people learn from the university or colleges, like engineering, medical, but nobody tells us that after when you're successful, like suppose you're a doctor or you're an engineer, you're working, how to manage your wealth or where to invest and how to manage your money. Nobody teaches in the university, or wish I should know before. So whatever I learned till now in my till my professional journey, I would like to share with you guys. And please, if you like it, please subscribe and comment and share. Before we go more detail, I like to tell you that this is more like educational purposes. Please be careful when you are taking some decisions regarding your investment. Read carefully where you invest, what you do, and how you manage your money. But basically, I'm experiencing my journey, and this is more like a information as more like a educational purposes. So be careful when when you're managing your money one way, or you are want to use your money in some other way with somebody else. Yeah, managing your money. So today's topic, I'm going to discuss about SIP, STP, and SWP. Um, these three are very um, strong methodology people use, or I will say like tool people use to manage their portfolio, or I will say like manage their the money. Let's put it in that way. So SIP is basically systematic investment plan. STP is systematic transfer planning, and SWP is systematic withdrawal planning. I'll go one by one what it is and how people use it and when you can use it, right? So systematic investment plan is nothing but, suppose you are regularly investing in a certain money in either mutual fund, either in a stocks, or either you're just keeping in a bank for just like a regular interest, right? But you are doing in a monthly or weekly. So basically, there would be a regular interval at there. So suppose like if you have a $200 each month, you are investing in a certain funds or certain investment. So that is under SIP. Then the benefits of these SIP is it's automated and convenient, reduce the market risk as because it has that dollar cost average value in there. And then ideal is for those who are salaried and the steady income individuals. It's for them. Then the next thing is called STP, Systematic Transfer Program. So suppose like you get a lump sum amount of money. Suppose like you inherit a money, right? And then you are thinking what to do. So if you just put that money in a directly to investment, it's suppose like you are investing in a stocks, and then tomorrow stocks goes down. So basically you are losing money there. So how you do that? Instead of use the whole money, you transfer a portion of the money one by one, and then actually you make it as a SIP. So suppose like you have 10,000 or 50,000 lump sum amount, instead of putting all the money in a one account or one investment, what you do, take $2,000 each month and invest it, and then the rest of the money you can keep it somewhere. You get a definite interest rate. Suppose like your stock, you put it in a savings account, or if you just keep it in a checking account, some banks gives you 3 to 4% interest rate, so that you can get it. Depends upon where you are in the world, right? So the advantage of this thing is it's a low entry risk into volatile market. So whenever you goes in investment or keep the money there, there is always a risk inventory there, but it helps when you inherit a good amount of money there. So the next question is SWP. So if you ask like, okay, I'm investing so much, but when the time to withdraw the money, right? So the SWP is the tool where you withdraw the money basically, right? So what you do is basically after a certain time of period, suppose like you are investing $200 from now to your retirement, which is like suppose like you are in 30s and you are almost like 20 or 30 year invested $200 each month, and you want to now withdraw the money. So then you can withdraw the money according to your monthly expenses. Suppose like you want to withdraw $2,000 or $3,000 monthly there. So you can withdraw the money, but the rest of the money is there still working for you. So that's basically systematic withdrawal plan there. So where you can see that you can get a tax benefit because you are not withdrawing the money the whole at a time, but you are withdrawing a certain portion of the money that is only not needed, but the other money is still growing as you think about that already. You're not uh, not inputting the money, but you are just withdrawing the money. We'll explain more on SWP when we get an example. But when we look for these three things to basically compare, we see that the SIP mostly used for regular investing, where STP is more like a fund relocation, and then SWP is regular income withdrawal if you want. Who can do SIP? Any beginners. Even though you have a $50 per month, you can start SIP. It's very highly recommended tool. Those who want to build wealth there. Then STP, when you are investor with a lump sum money, suppose like you inherit money or you make a money out of that. So what you do then the STP works. And then if you retire, and then those who need money after that, then the SWP works. The cash flow direction, it could be for SIP, it could be happening from a bank to bank, or you can buy a mutual fund, or you can buy a stocks. Similar same thing is STP2, same way it works like bank to bank and the stocks, but then SWP is like you are withdrawing your money basically. Either it could be a bank or the stocks or a mutual fund, whatever it works, right? Then the tax implication is basically if you take out the money SIP, then you have to pay the taxes on the capital gains. For the STP, yes, you can have to pay the money on the capital gains or the redemption. So basically, if you are taking money out of that, but in SWP only you have to pay the money on only the money you are picking up from for each month, whatever you needed, right? So now, if you look at as a scenario over here, think about Alex, who has the age 30, who wants to put $500 per month for 20 years for the retirement fund to grow. So that's basically SIP. So if you're starting a job, if you are basically early in the stage of the of your life, so SIP is the tool is recommended there. Then think about the Maria, which is 45 and received $100,000 from inheritance. So that's the time is STP. So you park that money somewhere where you can get all the benefits, suppose like 4%, 5%, or 6% from any regular for sure. Basically, you'll be getting the interest rate there. That, and then you pick up a small amount each month, suppose like 4,000 per month for your investment over here, right? The next thing is the debit, which is 65. You use the SWP, which is like 1,500 or 2,000, depends upon how much you need it. In there, you'll be working there. Now, the next thing, what is I did is important to show you that a comparison how these things works, and then if I want to compare, if you are investing on SIP, and then how it will grows, and if you are not investing in SIP, then how it will be growing, right? Suppose like you are investing each month $200 monthly, right? You do not put it in a SIP, you just keep as it is in a bank, no interest. So how it goes in a 5 years, that you'll be getting in $12,000, where SIP I'm looking at only 10% return. If you look at the $15,616, so almost $3,000, $3,600, you are getting more in just a 5 years. Only $200 each month you are investing there. Then, if you are looking at 10 years, then you will see that if you are not investing in SIP, the difference is almost from 24,000 to $41,000. So around almost near 1.8 times you are losing the money. Then in a longer time, like SIP is very powerful if you are doing in longer time, right? So then in 15 years, you can see that if you are not investing, you will be stuck in $36,000, where if you are investing on the green thing, you can see that $83,000. So almost there are 50,000 differences out there, right? Now let's go to the next another scenario over right there. So depend upon where you're investing. So if you just keep the money as it is, no growth, which is the pink line, then the blue line is basically is only if you keep it in a savings account or checking account, the banks gives you 4% rate, and then you do the SIP. So what are the difference out there? Let's look into that thing, right? So if you see that if you have $200 each month you're investing, that's again same thing. You'll be making $12,000, $12,000 in 5 years. There's a no growth, nothing, just the month you put it there, just the money you put it there. Then if you just ask the bank that, okay, give me the 4% where I just parked my money, you will be getting $13,300, which is like $1,300 more. But if you are looking for SIP who gives a 10% return, at least you will be looking for something like that. It will give you $15,000, so 15,600. So it's actually compared to here like $3,600 more, right? Then 10-year scenario, right? Same thing, you'll be getting $24,000, no interest. But if you're getting only 4% dollar, you'll be getting only 29 5,000. So around like $6,000 more lump sum. Let's put it in that way. And then if you are putting in SIP, $41,000. So you can see the differences are there. Let's look at the the 15,000 scenario. So 15,000 scenario, we can see the 36,000 only for just parking the cash. If you are putting in a bank with a 4% return is around $50,000. They can give and take, where $83,000 in SIP, right? So the next question is comes like, okay, so where I put my money, as you are talking about SIP, right? So if you look at the S&P 500, the return for last 5, 10, and 15 years, I pull the data out there. So what does it mean S&P 500? S&P 500 is basically nothing but top 500 in the companies are enlisted in US stock market, which is a New York Stock Exchange. There's the 500 top 500 companies. So you don't have to think about anything. If you just think about that, why I want to put it there, I don't know the numbers and all this thing. If you just think about just I want to invest on the top 500 company in the US, which is basically the S&P 500, and I want to comparison how it works, right? So last 5 years, S&P 500 return was 14.32%. 10 years is annual return was 12.99%. Let's put it as 13%, and 15 years they give us like almost 10.71% in a return, like last S&P 500. So I build another comparison chart here to show you that if you are doing S&P SIP in a 10% on average versus S&P 500 historical average, if you just park your money, how much you can make, right? So you can see like 12,000, and then you can make actually 7,500, 17,597, which is a difference around $5,500. And if you're looking at the long-term market on a 15 years, you can see like 36,000 and 90,000 you are looking at, almost three times you are looking at. And then think about how much you are saving each month, only $200. If you can keep those who are getting a bi-weekly money as a paycheck, from a paycheck, only $100, you keep it in 15 days to save, another 15 days to save. And look at after 15 years, you will have a $90,000 in your hand. If you like this video, please share with your families and look out for my next videos in this series. I will give you more details on SWP and STP, how it works. Thank you for now. Please not forget to subscribe my channel. Thank you.